Hello, everyone. Welcome to the stream today as we continue with our discussion for the November 2025 examination. We've been spending the time looking at the various things that we have to focus on, solving some questions, discussing the accounting standards, and trying to crystallize the principles when it comes to the various things. And that is exactly we want to continue. That is what we want to continue with today as we touch on some of the things that we need to understand when it comes to financial reporting and corporate reporting. Today we are turning attention to put the pieces together, and that is going to mean that we will solve a final account question. So we're going to be spending the time to solve one final account question like that, to see how we can really prepare financial statements and do all of the workings. One of the things you must understand is that when it comes to the single entity financial statement, whether you are doing cash flow or you are doing statement of profit or loss, statement of changes in equity, and the statement of financial position, you are still going to be required to apply the accounting standards. So in application of the accounting standards, it is going to be dedicated or in the single entity financial statement. So that is what we want to get ourselves into today as we continue with our discussion. Remember that you can still register to study and get access to our content by visiting our website. Let me bring up my screen quickly and then let's go. Also note that we have our books available that you can get copies of. So financial reporting, corporate reporting, advanced audit and assurance, strategic case study. We have the taxation book available, the management accounting book available, financial management. So we have our books available that you can get copies of by calling the number you see at the bottom right corner of the screen. You can send a message on WhatsApp about that, and then certainly you will be assisted to be able to get copies of our books. Also note that you can get access to our complete question course live on our website. So if you are writing financial reporting, whether in ACCA or you are writing in ICAG or you are writing in ICAG or any other professional qualification program, and you're looking for questions that will help you go through the syllabus, the standards, the single entity, evaluation of financial statement, consolidated financial statement, then our practice questions will be the best that you need. So visit our website, NhyiraPremium.com, or you can still send a message on WhatsApp and you'll be assisted so you can get access to those contents to help you so you can prepare well for the examination and pass the exam. Remember that, as always, you have to really expose yourself to a lot of questions. It's one thing to understand the principles. It's one thing to say, yes, I get a concept, but then you need to expose yourself to questions coming from different angles and different perspectives. And that is exactly what our practice question courses are meant to be. And so you visit our website or call us or WhatsApp us, and you will be assisted to get access to that course. And I can guarantee you, you will really get access to valued content that will help you so you can prepare well for the examination and pass the exam. If there are any questions also, you can put them in the comment section or the chat for me, and I'm going to be providing you with all the answers that you need. So let's go into our discussion for the day. We are looking at November 2024 financial reporting, November 20 ICAG, November 2024 financial reporting, and we are focusing on question 3, which is the single entity financial statement. It has a number of things that we want to use as a guinea pig to get excited into our discussion. So we go straight up into the requirements for 20 marks, 36 minutes. The examiner says, prepare and present a statement of comprehensive income for the year ended 31st December 2023 for Fan Bala Limited, and a statement of financial position at that date. So we know it's a single entity financial statement question, and we are preparing the statement of profit or loss and other comprehensive income, and also coming in with the statement of financial position. So let's go up, read a preamble. We're going to ignore the trial balance given, then we'll come to the footnote, walk through, apply the standards, and boom, we continue with the discussion. So let's put our company up. What name is this? Fan Bella Limited. Okay. We're going to start with our workings, as always. So let's see. Fan Bella Limited, a well-known company manufacturing trail rides. During the current economic climate, Fan Bella has experienced some difficulties and unfortunately has had to close down its merry-go-round division. Okay. The company's trial balance as of 31st October 2023 is as follows. Right. So we see the trial balance given to us there. But what we're going to be interested in is to go into the notes, because the notes will automatically bring us back into the trial balance and then guide us on what we need to do there. Revenue includes VAT of 72 million Ghana cedi. Remember the original question, you are working 3 zeros up. So when you pick the figure in the note, you're going to be canceling 3 zeros. Now, revenue includes VAT of 72 million Ghana cedi. VAT is not income for the entity. VAT must be remitted to the Ghana Revenue Authority. And so quickly we need to start adjusting our things. So we come to revenue. So we are working 3 zeros up. So we'll say as per trial balance. So we check the trial balance. The revenue item is the first information, 1,296,000. 1,296,000. So we're going to be lessing the VAT, which is included there. They said 72 million. We are working 3 zeros up. So that's going to be 72,000. So that is the idea there. So that's the adjustment we make for that note there. Let's continue. Included in property, plant, and equipment is a building with a carrying amount of 54 million. So go back to the trial balance and you can see property, plant, and equipment at 1st November 2022. Now, if the year ends on 31st October 2023, then it starts on 1st November 2022. So 1st November 2022, what we are seeing here is the carrying amount of assets at that date, at the beginning of the year. On 1st October 2022, which is the beginning of the year, it was revalued to 72 million. So what is happening here? IAS 16, revaluation of assets. And when assets are revalued, what happens is that the revaluation surplus is going to go into the P&L account the revaluation surplus will go to the OCI unless the asset had previously suffered an impairment, then the revaluation surplus will be written off in P&L with the excess amount rather taken to the OCI. So quickly, I want to go into workings 2. You want to make sure you're leaving reasonable space. And we're going to have the property, plant, and equipment. So property, plant, and equipment. From the look of things, it means the properties is being separated in respect of the building and the other property. So we will do the same thing here. So we'll have the building coming up. And then we'll have others coming up. Then maybe we'll have a total here. Working 3 zeros up. There. So we bring in the carrying amount at the beginning of the year. 1st November 2022. The building carrying amount is 54 million. So that's 54,000. The others will mean the balancing figure. So the total is 1,620,000. So the balancing figure will be for the others minus 54. And that is 1,080,000. 1,080,000 for us. No, I did 540. Okay. So 1,566,000. All right. So let's go. On that date, the beginning of the year, the building was revalued to 54 million. So we bring in the revalued amount. At the 1st November 2022. And they said 72 million. Again, you see that I read, hold my breath, interpret, right? So the balancing figure for the building, 5472, has gone up by 18,000. And that's going to be revaluation surplus. And we'll take that to the other comprehensive income. And also revaluation surplus under equity. Then let's continue to read. The building had an estimated life of 25 years when it was purchased 10 years prior to the revaluation date. This has not changed as a result of the revaluation. Stay with me carefully here. Stay with me carefully here. So the asset was bought 10 years ago, had a life of 25 years. So at the date of the revaluation, what is the remaining useful life? The remaining useful life of the asset will definitely be 10 or 15 years. So remaining economic useful life of the building. It has 25 years. It was bought 10 years ago. So we're left with 15 years. So now from 1st November 2022, that the asset was revalued, we will now depreciate it over the remaining economic useful life of 15 years. Because remember, once an asset is revalued, depreciation is charged using the revalued amount over the remaining economic life of the asset. So let's continue. I'll come back to that. The directors of Fanbella wish to incorporate this value in the financial statement for the year ended 31st October 2023. Okay. All other property, plant, and equipment are to be depreciated at 20% per annum on a reducing balance basis. All depreciation is to be charged to cost of sales. So we are done reading. So let's calculate depreciation here. The building is going to be 72,000 divided by 15 years. Right? So 72 divided by 15 years. That is 4,800. We take that out. So we have 67,200 for the building. Then we go to the others, because they said all other property, plant, and equipment are depreciated at 20%, reducing balance. So they were not revalued. So we'll still have the 15,66,000. So the depreciation will be 20% on that figure. So 15,66, 1, 2, 3, 0.2. And that is 313,200. So we subtract that. and that is 1,252,800. So we add it up because we need a total depreciation. 1320123. All right, that is going to go there in the statement of financial position. The total depreciation 48 plus 313, 200. And that's 318,000 for us. Then the total there 72,000 plus 1566123. That's 1638,000. And so they said all depreciation. So when we go to the statement of financial position, which we're going to be preparing, then the property, plant, and equipment will now be 1,320,000. But they said all depreciation is to be charged to cost of sales. So we go there for all depreciation to be charged to cost of sales. So I go to my workings 3, and that's going to give me cost of sales. So we bring as per the trial balance on cost of sales. As per the trial balance, 546,480. So as per trial balance, 546,480. Then we bring in the depreciation on PPE. From workings 2, professional presentation, 318,000. There we go. So that is footnote 2, IAS 16, revaluation of assets and depreciation of assets. Very sweet, simple, straight to the point. Note 3. On 1st October 2023, Fanbella closed down 8 merry-go-round division. The results of the division from 1st November 2022 to the date of closure are included in the above trial balance as follows. So if you check, on 1st October 2023, that is 30 days to the year end, they sold a division. And we are preparing the financial statement for the year ended 31st October 2023. Now, if a segment of the business has been sold, then the results and the effects of that segment must also be eliminated from the financial statement, as at the reporting date, certainly. And so what happens is that the contribution of the division, as seen here, must be deducted from the total contribution here so that we can prepare the statement of profit or loss for the continuing operations of the business. Very important. Then we can check out the division that has been disposed of. What is the profit or loss that he made on that? And that will come as a line item on the face of the financial statement. So let's go. The revenue from there is 58,800. We'll subtract that from the revenue. So we less division sold. 58,800. We take it out. We do the same thing for cost of sales. Less division sold. And that is 38,700. Next, distribution cost, admin expenses. All that must be adjusted. So I'm going to do some of the workings on the face of the financial statement so that we have a balance. So this distribution cost, and then the admin expense, if there are no additional information, then I would want to do it on the face of the financial statement. 12,240 for the distribution. And then admin is 11,180. Okay, 11,880 rather. So I would want to do this on the face of the financial statement, because remember, you are working with time. So some of the workings, very simple like this. If we don't have a lot of information about it, then we want to just do it on the face of the financial statement. So I will do this on the face if we don't have additional information coming up for the period under review. Then we go to the net assets of the division were sold at a loss of this. So the net assets of the division were sold at a loss of this and are currently within cost of sales. So relax. This loss of 19,200 is included in the cost of sales. But really, loss from disposal of a division should not be part of your cost of sales. So that is a wrong accounting policy application. So we have to take out that loss from there in the cost of sales. So we less loss from disposal of division, because it is not supposed to be in cost of sales. 19,200. If anything, loss from disposal of assets should be part of a different line item on the face. So it cannot be under cost of sales. So we will take it from cost of sales. But now it means that we have to work for that division that has been sold and build it into the system. So workings for. Let's look at the profit or loss on the discontinued operation, which will come as a line item in the financial statement. So from the division that has been sold, this is their data. So I'm going to just bring that data up here. That's a lazy boy. Because I want to simplify my workflow. So that is it. And we're going to subtract cost of sales, distribution cost, admin from there. So 58,800 minus 38,700 minus 12,240 minus 11,880. And that is 40,20 negative. So that division we sold, their results is even negative. So we bring in the loss on the disposal in addition to it. Of the net assets, so that it will come as a single line item on the financial statement, which is the 19,200. This is how we work this out. So it will be added, and that is 23,220. And this will come as a line item on the statement of financial performance or the profit or loss account. That is the idea about how you deal with that footnote there. Very important. Very important. Okay. So now the financial statement we are about to prepare will be the financial statement for the continuing division, because the division that has been sold, its effect has been adjusted for. So that is note 3, the disposal of the division. Note 4, the investment property owned by Fanbella has risen in value during the year by 5%. This rise is to be incorporated in the financial statement. Fambella uses the fair value model to value investment property in accordance with IAS 40, okay? Investment property. So if we go back up in the trial balance, you can see investment property here. So let's work for that in note 5. Investment property. So we bring in the opening figure. So it means what is in the trial balance is the opening figure. So balance brought forward, 270,000. Then we can get a balance brought down, which is the closing figure. They said it has gone up by 5%, right? So that will be 1.05. So 270,000 by 1.05 will give us the closing figure. And that is 283,500. And that is what will go on the face of the statement of financial position. So that the balancing figure is a gain on the investment property, which must be recognized in the profit or loss. And that is 13,500. So that will come in the profit or loss. Now, if you check again in the trial balance, you would realize directly that there is investment income here, 28 and 80. It will be prudent to add that fair value gain from the investment property to that figure because they are all from investment issues so that it will come as a line item on the financial statement. And I'm going to be doing that also on the face of the financial statement. So 13,500 will be added to that figure. Okay, to be done on the face of the financial statement. The reason I'm doing that is also to let you understand that, yes, there are a couple of the things, they are simple adjustments that can be done on the face of the financial statement. So we wouldn't have to spend the time to open the account and work for them separately because we can simply do the adjustment on the face of the financial statement, save some time, and then continue with the discussion. So that is note IAS 40, investment property. Then we come to our regular customer that, whether you like it or not, will be there always. And that is the issue in respect of IAS 12, income tax, note vein. It is, the provision for income tax for the year ended 31st October has been estimated at this figure. Okay, so what do? Simple. Note 6, income tax. So we're going to bring in the issue in respect of the tax. I want to see whether I can put it with the deferred tax together. It says, for deferred tax provision, the only temporary difference are accelerated capital allowance. At 31st October, these were this. Income tax, it's 25%. Okay. Now, there is a deferred tax as well. Normally, movement in deferred tax, if it is arising due to the revaluation of assets, we'll take it to OCI. In the context of this question, we are not told that the accelerated capital allowance is due to the building that they revalue during the year. For that reason, what it means is that both the deferred tax movement and then the normal income tax movement will be taken to the P&L account as a single item there for us. Okay, will be taken to the P&L account. Again, it's discretionary here. So deferred tax on 1st October, you can see the opening figure. Do we have current tax available as the opening figure as well? Let's check that well. Yep, you can see income tax here. So that is the opening figure, current tax opening. So let's go there. I'm going to put the two together, as I mentioned, in a T account. So we bring in the balance brought forward, what is in the trial balance. The current tax, the deferred tax. So the current tax, let's clean some of the things here, is the 10,800. Deferred tax at the beginning of the year, I think is 70. 75,600. So you're going to pretend to close this account. So you get a closing figure. Current tax is the provision for the year, which we are told is 140.4 million. So 140,400. Then we'll have the deferred tax, which we are told is because of the accelerated capital allowance, which is 129.6 million. Tax rate is 25%. So we're going to calculate that. 129,600 times 25%. And that is 32,400. So remember, this deferred tax is non-current liability on the face of the statement of financial position. The current tax will go under current liability on the face of the statement of financial position, right? Principles. So that is all about the deferred tax issue. So we balance the account up, the balancing figure will go to P&L. Again, as I'm emphasizing, sometimes movement in deferred tax must be taken to OCI. In this question, it is quiet. Also, there was a revaluation of the building, and revaluation of building may have resulted into deferred tax issue. But in the context of this question, we are not told that the deferred tax is because of the revaluation of assets. If not, then any movement in the deferred tax, a portion would have gone to the revaluation surplus and the OCI, then the other portion would be what we would charge to the P&L account. It does not apply in the context of this particular question. So let's balance the accounts up. 140, 400, 32, 400, and that is 172, 800. 172, 800, so that the balancing figure will be the charge for the year, which will go to P&L account. Minus 108, 75.6, and that is 86,400. So that is our income tax, and that will be going into the P&L account. That is the idea about Note V, IAS 12, income tax. It's a regular customer that you are going to be seeing with IAS 16 coming in when it comes to dealing with the single entity financial statement. Whether you are doing cash flow, you've seen it, statement of profit or loss, and financial position, you've seen it. So IAS 16, IAS 12, like you don't have any excuse, especially if you're a financial reporting student, because it's going to be there. Corporate reporting, you still don't have excuses. You don't have any excuse because these two standards will definitely be applied some way, somehow, or some shape or form in the exam hall, all other things being equal. Then we come to the final note. At the year end, 31st October 2023, inventory worth 46 million was damaged. These could be reconditioned at a cost of 12 million and sold for 52 million. Okay. So inventory damage, that's IAS 2. So inventory should be carried at lower of cost and net realizable value. So let's see note 7, my last note. Inventory. So if we check the trial balance, let's go to the trial balance. Remember they said inventory here is 108,000. So permit me, because I want to do the workings well. So as per trial balance, so as per trial balance, 108,000. Then we work for the parts that has been destroyed. So on the damage inventory, we're going to have the cost. So the cost of the inventory is going to be, they said 46,000. Then we're going to look at the net realizable value of that. And the net realizable value of that is going to be the selling price minus the cost of the repair. So 52,000 minus 12,000, the cost of the repair. All right? And that is 40,000. So the damage inventory should be carried out lower of cost and net realizable value. So it will be carried at the net realizable value. So there is a 6 million there as the impairment, so that it will be deducted from above, and the value of the inventory will now be 102,000. That is what you must understand about this particular treatment. So that is the closing stock. That will go to the statement of financial position. Now, that 6,000, the fall in the inventory, will be added to cost of sales if we want to. So, impairment of inventory and that is going to be 6,000 here. So to be added to cost of sales. So because the double entry is to debit cost of sales and credit inventories, right? That's the idea there. So it looks like we are done reading, and these are the various adjustments we can do as per the context of this particular question. So let's go and add the pieces together here. So we start with the revenue to get a total. And that is 116,500. We bring this up, 546,480, 318,000, 38,700, 19,200, plus 6,000. That is 812,580. Discontinued operation, we're going to bring it up later. Property, plant, and equipment, income tax, we are done. Inventory, we are done. So now we can extract the financial statement. Remember, the financial statement we are extracting is for that continuing operation. So we bring in the first part of our question. And that is the statement of comprehensive income for the year ended 31st October 2023. We slash in our currency sign, as always. We'll have revenue. We'll have cost of sales. So we bring in the workings straight up. Revenue from workings 1, 1,165,200. Cost of sales from workings 3, and that is 812,580. And we get gross profit. So 1,165,200, and that is 352,620. Then we bring in the distribution cost, and then administrative expenses. Remember, we said we're going to work for these on the face of the financial statement. So if we are going to work for this on the face of the financial statement, give me a sec. So admin expenses is 127,080 minus 12,240. So we subtract it up. And that is 114,840. So this is what I meant by doing the workings on the face. We do same for admin, 142,560 minus 11,880. 142,560 minus 11,880. And that is 130,680. Okay, so we less these up. Then we can get a profit from operation, or if you want, operating profit. So 352,620 minus 114,840 minus 130,680. And that is 107,100. That's the operating profit. Then remember the investment income, right? So we bring it in. So investment income. That is 28,080 plus 13,500. The fair value gain on the investment property, right? So 28 680 plus 13,500. That's 41,580. All right? So we add that up to get a profit before tax, profit before interest and tax. Plus 107,100. That's 148,680. Then we bring in any finance cost. If you check, pay attention closely. There is interest. There is loan here, 432,000. Then there is interest paid here. So let's see. 0.08 times 432,000 is 34,560. That is the total interest payable, but they've paid 17,280. So the remainder of that will be under current liability on the face of the statement of financial position. So I'm going to be doing that as well, but we're going to bring the total amount here. So finance cost, 8% on 432,000. So 34,560. Then we can get a profit for the year. Remember, this is profit for the year from the continuing operation. So minus 148,680. And that is 114,120. Then we can bring the discontinued operation issue. So the discontinued operations, we got a loss, if you remember, from workings 3, I guess. No, we start from here. Yeah, workings 4. We got a loss of 23,220. So loss on discontinued operation, workings for 23,220, and that gives us the profit for the year. You see the way the picture is, which is 9,900. I've not brought income tax. Give me a sec. I've not brought income tax. So in any case, how can I forget that? Because we did income tax. So let's push this slide a little bit down so that this will be profit before tax. So let's bring that in. So this will be profit before tax. So we can bring in the income tax that we worked for here, working 6, 86,400. So that gives us the profit for the year. So 114,120 minus 86,400. That's 27,720. So we less that 23, 220, and that is 4,500. And that is the profit from the operation. But remember, we are doing OCI, or comprehensive income, so we bring in the other comprehensive income, and that's going to be the revaluation surplus. From workings 2, if you remember, the revaluation surplus was 18,000. We were not told the entity makes any transfer, so we're going to bring the 2, because if you remember, normally when an entity revalue assets, depreciable assets, more depreciation will be charged than it should have charged, and so we have to compensate the shareholders. But in this question, they didn't say we should, and the question is also quiet, so we can decide to ignore. So we get a total comprehensive income. So it will be added to the 4,500, and that's 22,500. This is the statement of comprehensive income for the entity. So you realize that once you're able to understand the principles in respect of the standards, you are okay when it comes to the actual financial statement preparation. Please give me a sec. Okay, let's go. So we go to the statement of financial position to clean it up. B. So statement of financial position as at 31st October 2023. We tell the examiner for the statement of financial position, we like to work into cash column. All right. Then we start with non-current assets. So under non-current assets, we bring property, plant, and equipment. We worked for this, so let's go pick it up from workings 2. If you remember, 132 or 1.320,000. So that's going to come here. Then we bring in the investment property, because that's also a non-current asset, from workings 5. So investment property, workings 5. How much we got? 283,500. Are there any other non-current assets? You want to make sure you've touched on everything that you have to touch on. Property, plant, and equipment, investment property, that's all. So we get a total non-current asset. Then we can bring in the current assets. Under current assets, we bring the inventory. Is it tree or trees? It's trees, okay. Inventories. we worked for that, so we're going to bring in the value we got, which is the 102,000 from working 7. 102,000, okay? What else we have as a current asset? Do we have receivables? Yep. You can see trade receivables there. So trade receivables, we bring in 135,000. How about cash and bank? We see bank on the debit side, that's an asset. If it's on the credit side, it's a bank overdraft, and that will be under current liabilities, right? Principals. So that's 64,800. There we go. And I think that is all. There were no prepaid expenses and others, so that is all. So let's add the pieces together now. 102, 123, 135, 123, 64,800, and that is 301,800. Then the non-current liability, and that is 1,603,500. So we add it up to get our total assets. Sorry. Total assets plus 301,800. And that is 1,905,300. Then we go to equity and liability. Equity and liability. Liabilities. So under equity, we're going to have, what do we have? Ordinary share capital, 540,000. Ordinary share capital, 540,000. Then we bring in the retained earnings. Remember, the profit for the year must come in the retained earnings, so we can do it actually on the face of the financial statement. The opening figure is 605,520. We add the profit for the year from the P&L account, 4,500 to that. We could have done it as a separate working, 605,520 plus 4,500. And that is 610 and 20. No dividend was paid during the year, because if they've paid any dividend, it would have also been deducted from the retained earnings. But in the trial balance, we've gone through all the items. No dividend was paid. They didn't also issue any shares. Then we bring in the revaluation surplus from the workings 3 that we brought in the OCI. So revaluation surplus, the 18,000. Okay. That's it about that. There were no other elements of equity, like if you want, we didn't have anything like convertible loan note and others in the context of this question. So we can get total equity here. So plus 540,000 plus 18,000. So total equity is 1,668 and 20. Then we bring in the liabilities. Under liabilities, we're going to have non-current liabilities. From the look of things, I would have to continue with my liabilities on the next slide. So under the non-current liabilities, we'll have the 20% loan note, the 8% loan note coming up. The total figure there is 432,000. Then what else will come? The deferred tax that we did is a non-current liability. So from the tax account we prepared in working 6, the deferred tax closing figure 32,400. $32,400. I could bring that on the first cash column, take the total to the second. Are there any non-current liabilities? I think that is all. Then we bring current liabilities. Do we have trade payables here? Yes. You can see payables, 43,200. Then the current tax. The current tax. That was given in the notes directly. It's a current liability, 140,400. We bring that. Then the interest outstanding. If you remember, the total interest payable was 34,560, but they've paid 17,280. So 34,560 minus 17,280. Okay, the same answer. So it's like they paid half. So 17,280. Okay. Then we see what else we got. Think that is all. Now, this VAT issue of 12 million, what it means is that, as we mentioned in the beginning, it is payable to the Ghana Revenue Authority. So if it is included in the revenue and we debited the revenue to deduct it, then the credit entry must be in the VAT account. So it means that figure is outstanding and it will come under the current liability as well. So VAT withholding, 72,000. Because double entry, debit revenue credits the VAT account. And I think we are done. We've touched on everything that we are supposed to touch on based on the context of the question. Let's see if we will have faith in our balance sheet. My current liability is 272,880. The non-current 32,400 plus 4,232,000. That's 464,400. So we add the 3 up plus 272,880. Then the total equity 1168.20. Yep, our balance sheet has balance. At least it means we are in a comfortable lead. You know your balance sheet can balance, but you have screwed up somewhere. So total equity and liabilities. That is the answer to the question for 20 marks, and you're supposed to do this in 36 minutes. IAS 16, IAS 40, IAS 2, and then IAS 12. So IAS 16, IAS 40, IAS 12, IAS 2. So these are the thematic accounting standards that are applicable in the question, plus certainly the conceptual framework. So that's what you must understand there in respect of this question. So slide 1 there for us. Slide 2, workings 3 and 4. Slide 3, workings 5 and 6. Slide 4, the inventory, working 7. Then the statement of comprehensive income, the beginning aspect. The wrapping up aspect of the comprehensive income. Then the position, bringing all of the items in. Then the wrapping up segment. So technically, when it comes to the single entity financial statement, as I say always, there is nothing difficult here, only your ability to apply the accounting standards. That's the only thing there that you must understand. Did you make ACCA F7? Yes, you can send us a message on WhatsApp and you can get information about our ACCA lectures, certainly. That's from Mascal Mail or Mascal Mall, okay, if I mention your name wrongly. So that's what you must understand. Remember, as I mentioned, you can get access to question sliders and many more segregated into the key areas of your syllabus by enrolling in the practice question course, which is available on our website. So you can visit our website, NhyiraPremium.com, the first link under this video or the second link, and enroll in that course. Or send us a message on WhatsApp, and let's make a recommendation on what will be appropriate for you so you can put yourself in the position to pass the examination. Remember, practicing questions will be crucial, but not just any questions. They have to be carefully selected questions that will really touch on the various aspects of the things that you are learning, so you can know how they will apply under various circumstances, so you can put yourself in the position and pass the examination. So that is it about that. We're going to wrap it up here today. And God willing, on Monday, we will continue with our discussion. Same time, 16:30 GMT, as we continue with the discussion. If there are any questions you have, any further information that you want, certainly you can send us a message on WhatsApp and you will definitely be assisted. Thanks for watching, and I'll see you next week. Have a great weekend. Bye-bye.